We're looking at the potential impact of the upcoming Fed meeting, which is a topic that Keisha normally covers for us, but tonight you have it for us. What's going on with the Fed meeting and what impact might that have on the international and regional bond market?
All right. Thanks again for having me. So if I may, can we go back to as far as the pandemic, COVID-19, where central banks were forced to actually embark on easing programs. The situation was further exacerbated by the Russia-Ukraine war. And during that time, the Fed actually cut rates twice, and those were both unscheduled in March of 2020. I think the first rate was, the adjustment was 1%, and the other one was 0.5%. So rates were basically at near zero during that time. At the consumer level, what had happened is that governments had provided grants and other stimulus, adding cash to an already fairly liquid system. Of course, most persons are already familiar with the disruptions that the pandemic would have caused to the supply chain, primarily on the basis that most persons wouldn't necessarily be able to move around as freely as they would have liked, and therefore leading to lower levels of productivity. Out of these programs, the easing programs, came the issue that we're faced with today. Too much money chasing too few goods. The net change in the price of goods and services consequently would have been adjusting at a faster pace than that would be preferred by central banks, aka inflation, right? Now, before March 2022, as I mentioned previously, US rates were near zero. Since then, the US Fed has actually raised rates a total of 10 times, which is an aggregate of 500 basis points, basic terms, 5%. They've only paused since then once, and that was last month at the meeting in June, right? As it stands now, analysts are actually predicting that at the next meeting, July 26th, there's supposed to be, it could be at 25 basis points, which is 0.25% increase, and then probably we will see a pause. But of course, the main catalyst in this puzzle is inflation numbers. Now, what has this really meant for the bond market? Now, bond yields are actually found using the risk-free plus a spread, right? Now, globally, the generally accepted risk-free is US Treasury bonds, right? The spread that I mentioned earlier is the additional premium that the market requires to take on an issue, whether it be a corporate or a government debt. These are due mainly from the credit rating as well as liquidity. Now, Treasury bonds have adjusted upwards in line with the Fed rate adjustments that I mentioned earlier. This therefore means that yields on bonds actually have been moving hard to keep the convention true. In some cases, you find that the risk premium itself had actually contracted somewhat, but overall yields are higher globally. It is important to note at this point too that there's an inverse relationship with bond price and yield, meaning that if the price goes up, the yield on a bond actually goes down. In the current scenario that we're experiencing, rising rates or yields, bond prices therefore have been adjusting lower, especially with those with less sound fundamentals. Now, on the domestic side, come back home to the Jamaica, CPI actually declined to 6.1% in May. The lowest that we've seen in almost 2 years, but still outside of the 4.6% BOJ target. It's expected that the BOJ probably will likely keep rates current at 6% at the next meeting, I believe, on the 18th of August. The fundamentals basically, as it stands now, actually point in that direction where, they don't necessarily need to be as aggressive. But to come back to the original point that I'm focusing on the Feds, it's likely that rates are expected to remain fairly elevated in end 2023 into early 2024. The current predictions as it is now anticipates contraction somewhere around mid 2024, where probably at that point now the central banks probably may have to consider some other expansionary policies. As it stands, given the aforementioned, it's possible that bond prices probably may experience further, maybe not necessarily as aggressive, but further declines, right? Which means that prices are actually likely to go lower, right? Prices lower, yields higher. As it's during this time, there could be some amount of volatility, maybe not as aggressive that we would have seen in prior months or even the last year when most persons weren't exactly sure how to position their portfolio. So as a recommendation, what you want to look at is instruments with stronger fundamentals, where the ratings are a little bit higher and they're sound where cash flow especially are concerned. Now, one of the questions that probably might come up is what exactly are other options that the Fed could use instead of continuing to raise interest rates? There are OMO operations, open market operations, where they could actually, that really entails the purchase or sale of securities. They could also adjust the reserve requirements. So those fall with among the top 3 tools that central banks usually use. I rambled on a lot. I hope I've enough and clear.
Yeah. So what do we do now with our money?
Well, as it stands, and I think I mentioned it prior, that you want to invest in securities that have better fundamentals in terms of ratings, and I did also mention the cash situation, because what's happening now is that it's one of the issues that was created out of the banking crisis earlier in the US, right? Now, what had happened is that a lot of the banks had longer term assets on their portfolio that weren't necessarily repricing as fast as their debt obligations were, right? So at this point, I'd say until we get a clearer picture of whether or not the Fed is likely to go beyond 5.5%, you want to stay on the shorter end of the curve until things kind of level off. At that point, now you probably will want to look for longer dated securities, again with relatively sound fundamentals.
And when is that meeting expected?
For this month, July 26th.
Okay. Yeah. So we look forward to that.